Case for a chat here being the traction in Naukri, 99 acres, the contribution they've had from Policy Bazaar, Jeevan Sathi, and of course the impact of on Zomato of the logout campaign by restaurants. That's also something that we would like to get a brief highlight on. Let's welcome on board then Hitesh Oberoi, co-promoter and MD and CEO at InfoEdge. Hitesh, hi, good morning. Good to have you on the show. Firstly, help us understand what really are the feelers that you're getting in terms of a recovery at all, if at all, in the job market?
Well, it's a mixed bag from what we are seeing, and I have numbers till July. We track job listings on our platform. We reported our revenue very recently, last quarter revenue very recently as well. It's a mixed bag, like I said. So sectors like IT-enabled services, healthcare, education, travel, tourism, these sectors seem to be fine, and they're a large part of our business. About half our revenue comes from these sectors. But sectors like construction, real estate, telecom, and now even sectors like auto ancillaries, financial services, they seem to be in trouble. So certainly job growth in these sectors has taken a hit, but the other sectors seem to be just fine.
Should we ask you on your view on Zomato whether they should have logged out from the restaurants or not? Personal view. I'll get into what it means for InfoEdge, but personal view. I've paid money. I've paid money. What do I do now? I'm not getting the discount.
I am not really clued into the controversy. I focus on running the InfoEdge business. Dipinder Goyal runs the Zomato business. Maybe you should ask him.
I'm asking Hitesh, the consumer here.
As a consumer, I continue to see a lot of value in the Zomato sort of offering. It's the go-to place when I want to sort of figure out a new place to eat in Delhi. It's the go-to place when we want to order at home. So as a consumer, I continue to see great value. I don't really have to have a comment on the controversy. I don't know the details.
Fair point. I'd see a marked slowdown suddenly in the initial startups, but I see a lot of interest what is happening at the unicorn level. When I say that, I can, SoftBank is putting money into Policy Bazaar. SoftBank has decided to make some large investments, but those are sizable companies where large investors are now putting money, not startups, but perhaps mature businesses and recognizable startup. But the real startup, the seed capital startup, that space seems to be contracting. Is that true?
No, that's not true at all. See, what has of course happened over time is that the large checks are going to a few companies. So when you look at checks above, let's say $50 million or $20 million plus checks, there are a handful of investors who have the ability to write these checks. And these checks are, of course, going to a few companies. But there's a lot of activity in the entrepreneurial ecosystem, in the funding ecosystem. There are all kinds of VCs out there. There are angel investing, sort of people who are doing angel investing. There are seed funds. There are funds who focus on Series A and Series B investing only. They don't cut very large checks. So, and we also, as a company, also continue to invest in some of these startups. And there's a bunch of people out there, trying to do something on their own. So there's a huge pipeline of startups, and there is no dearth of investors who are willing to sort of sign smaller checks and invest in these startups. But of course, as the game gets bigger, as you sort of hit Series C, Series D, there is a lot of filtering which takes place, which is very natural. And there are just a handful of investors who are willing to cut those checks.
Okay, so let's just talk about your outlook with regards to growth, because given the tightness in financing for realty, which has affected new launches, to what extent is that weighing on 99 acres? I want to talk about that as well. And going forward, when you're looking at revenue growth across businesses as well, what's the kind of outlook you have currently? And do you see a pair down like you took in Q1, or do you feel perhaps now things are, slowly going to be looking up?
Yeah, so let's talk about 99 acres first. So the 99 acres business has done reasonably well over the years in a contracting market for real estate advertising. We managed to grow every year for the last few years. In fact, last year was a great year. The business grew at over 35%. We definitely saw a slowdown in Q1 of this year. Our billing growth contracted. I mean, from 35% growth, we went to 17-18% growth. So we saw a slowdown, and this slowdown was very pronounced in certain markets. So Bangalore, for example, as a market, continued to do well. And if I connect the dots, it's probably because the IT market, the job market in Bangalore is still buoyant, and people are still buying real estate, even though there may not be enough funding available. But definitely when we speak to our clients and when we speak to our sales people, what they say is that new launches have definitely dried up. So there is not enough funding available for new launches. The focus is on completing existing projects. And of course, there's a lot of bad press around real estate, especially in markets like NCR, where projects are still 7 years behind schedule, and many people are being taken, many sort of builders and developers are being taken to court. So that also sort of tends to have an impact on sentiment. But overall, it's not as if the market is down in the dumps. Transactions are still okay. They may not be growing, but it's like a flattish and sluggish market. You have to work hard to sell your product, but if you have a good product as a developer at the right price point in the right locality, there are still enough buyers in the market. As far as our overall sort of business is concerned, as you know, we are in 4 different sort of sectors. We have a jobs business, which is Naukri, and 70% of our revenue and all our bottom line comes from that business. That business has been growing at about 20% for the last few quarters. If the economy recovers, we would like to sort of continue to grow at that rate. But if things slow down, that business will take a beating. Growth will take a beating. It's cyclical in many ways. Every percentage sort of, every 1% difference to growth, impacts our growth rate by about 8 to 10%. So if the GDP sort of growth continues to be in the 6-7% range, we'll probably grow at 15-17%. But if it moves up, then of course, our growth could even move up by 8-10% points. And if it goes down, then we could get impacted as well. In the matrimony business, we continue to invest aggressively. Growth and that business is not cyclical, so it's responding to our investing, it's responding to the investments we are making. The Jeevan Sathi business in June grew at about 15-16%. In July also grew at about 15-16%. So it's a slow and steady sort of growth business, but we continue to gain share in the market. In the education business, which is Shiksha, we are now breaking even. It's a small business, but we're adding new verticals to the business. We see a huge opportunity in the long run in the online sort of education space. There's a lot of VC activity in this space, a lot of new startups. Many of these companies are going to sell courses online, and Shiksha will be a natural go-to place for many people to discover and learn about these courses. So on the whole, we are fairly buoyant about our prospects. There's a lot of areas we are investing in, and if some of these investments are successful inside the company, not just outside the company. We recently, for example, also acquired iimjobs. It's a very solid brand in its sort of category. We are going to invest aggressively behind that brand as well. So there are enough sort of growth opportunities, and we are sort of still very, very bullish about the prospects of the company in the long run. Yes, there could be a slowdown for 1 or 2 quarters, as the economy sort of recovers. But long term, I think the prospects are still very, very bright.
Also, Hitesh, newspaper reports are indicating that a deeply pocketed Amazon is mulling food ordering space, which can impact subsequent valuation rounds at Zomato, Swiggy, amid the already stiff competition from a dine-out, Easy Diner nearby, Uber Eats, etc. You have a 26.5% roughly stake in Zomato. How is it that you're watching this piece of news as an investor?
Zomato has been in the food business for almost a decade now. We first invested in Zomato, I think, in 2009 when it was a restaurant, a ratings and review company. And then over time, they went international, and then they sort of pivoted to food delivery as well. And in the last 10 years, we've seen many companies come and go. Even not just smaller competitors, but even very large competitors have taken a shot at this market, including Food Panda, Uber Eats, and the likes. I think both Zomato and Swiggy, if you ask me, are sort of streets ahead in this game. They have been at it for many years. They have a very, very entrenched customer base, both on the restaurant side and also on the buyer side. Their revenue models are set. I mean, Zomato has maybe more than 100,000 people delivering food, and food delivery is not the same as food. People expect their food to be delivered in half an hour when they order food, and that's not what, in my view personally, that's not what Amazon is sort of built for today. Of course, they could sort of get their act together and sort of figure out how to do this, but it's fundamentally a very, very different business from regular e-commerce, where stuff is delivered 2 days later, 3 days later, or a day later. Order sizes are small, and it's a fairly complex business. Of course, theoretically everybody can do everything, but it's going to take a lot of effort on the part of Amazon if they want to succeed in this business.
Appreciate your time. Thank you for joining us.